Alan, welcome back.
That's
Thank
me.
you. Thank you. We had a great turnout last month, and the demand was here for the daytime session. So that's why Alan is
And it would have
back.
been far better if she didn't have a whole bunch of people bail on her at the last minute. You know,
No wine and cheese today, unfortunately, but you know, it is during the day.
we can whine.
We could, better not. So I'm going to leave the floor to you, Alan. You guys have the basis of the background here, but I'm going to leave the floor to you to take over.
I have from
What
last
did you do?
time.
Oh, okay.
Hello, everybody.
Hi.
As Irene says, I'm Alan. I have been a professional cook for the last 30 years. So it's much more laughs than an accountant. I am a CMA, CPA. I have worked for myself for the last 15 years. I've been in the industry for a long period of time. In case you're curious, I do about 300 personal tax returns and about 45 corporate returns a year. So I spend a lot of time playing with numbers and people. And half of my job is just trying to understand what you guys are trying to do and how we're going to get there. So I've given most everybody just kind of one of my packages that I have here. Most of it is just tax stuff that's behind. I've summarized everything else on the top page, just so everyone is clear. So what it does here, the first one gives you what your federal tax rates are, and the breaks on the top page there. And then you have what you have, the provincial side of it, or the Ontario tax. And then I've just put it down below, kind of what your overall tax rates are, based upon if you were making $100,000 a year. Okay? It just gives you an idea, and this becomes very important when we start talking about mainly the kind of parts 4 and 5 on the listing that I had beforehand, and that's in regard to an incorporation. On whether or not it's a good thing, bad thing, whether it's for you, whether it's not for you. And a lot of it comes back to everyone's own personal situation. So we'll start off with the first one, is most people have got a house. And that's their main asset for most people. But all their money is tied up in their house. So what do? In a lot of cases anymore, you can take that line of equity, HELOC loans, whatever else that you want, and you can buy yourself a income property. Now what happens is the interest on that loan automatically becomes tax deductible against your income from the rental property. So if you have $1 million house and you borrow $500,000 against that house at 5%, just because the math is simple, that means it's a $25,000 interest expense over the course of the year. Well, that automatically gets transferred over against whatever income your rental property is going to make. So if your rental income property makes $30,000 a year, you're only paying tax on $5,000. So what it does is the government gives us a break on that aspect of it, which works out quite well. So, you know, kind of as you're going through it then, so it's like, and it ties in with number 2 that I had here beforehand, is okay, do we buy a rental property, or do we take part of our house and make it an in-law suite? Now, same rules apply. If you take $200,000 loan and take a third of your house and make it a in-law suite, a third of all that interest now is tax deductible against the income coming from the in-law suite. As well as a third of all your property taxes, a third of all of your repairs and maintenance, heat, hydro, water, and all the other goody parts that come along with owning a house. Now this becomes kind of very important, you know, as you get out and buy a secondary property or whatever else, because all those expenses now become tax deductible. Even some of your personal ones that you have, because hey, you need a lawnmower to cut the grass, well you charge it off against the rental house, but you use it to clear your own. You happen to have an individual that plows snow or clears all your sidewalks. If it's in the same neighborhood, you can clear both of them and charge it off against the rental property. Again, it's because this is what it's all about, is how do you guys get a benefit out of these particular aspects onto it. And that's what it comes down to. As you get, you know, kind of more and more, you know, into your houses, if you have a rental property that needs a new fridge or a new stove, well, who's going to get the new fridge or the new stove? It's going to be you guys. And you take your old one and put it in the rental property. Okay? And as you go through it, so again, whether it be lawn furniture, all these other things, because again, we're trying to just get you guys a benefit of what we have going on. Now, kind of as you go through this is that same equity that you have in your house. Most people want a cottage or they want a second property. Whether that be a condominium, whether that be a cottage, whether it be a timeshare, or anything along those lines. Again, unlock the leverage that's in your house and start to utilize it. Now, again, back to what we had here as far as your in-law suite with income property, if you buy a cottage, there's nothing stopping you from renting it. Because again, most people, most things being equal, and unfortunately most of you guys are real estate agents, when do you do most of your work? On the weekends. So the time over the summer is perhaps not the best time for you to enjoy that cottage. So why don't you rent it out and make it all a business expense, or for the most part a business expense. And that way then it carries itself, or perhaps even makes $1 or $2. I have a number of my clients, she has a cottage up in Halliburton, and it generates about $22,000 a year in income. It costs them about $14,000 to have it for the year, so they make about $8,000 on it. Now with that $8,000, they bought the boat, they bought all kinds of other goodies that come along with it. So it just makes life better all the way around, and they only pay tax on a little bit. Because you'll kind of come across all kinds of people out there, I don't want to pay the taxes, just put it in my pocket, I'm not going to worry about it. It comes with a lot of inherent risks at that particular point in time, because the government just loves undeclared income. Because the problem that you're up against is they just hand you a tax bill. Because they say, all right, you've made $10,000 a year. Now you're busted both ways, because if you prove them wrong, you say, oh no, I only made $6,000 a year. Okay, they got you income tax evasion, and they're going to hand you a very, very big bill, or you just pay the bill on $10,000 a year. So the whole object is, behind it is just get all of your expenses in a row, and put everything against it, and pay your taxes accordingly. And my viewpoint onto it is you'll get a lot of accountants out there, they're not aggressive enough, at least I don't believe they're aggressive enough. If we have a semi-defendable position of a business expense, write it off. Okay? Because Revenue Canada has to come back and tell us no. That means they have to pull you for audit, they got to flag you for audit, pull you for audit, and they got to come on audit. The odds of all three of them happen are pretty remote. Especially if you're only dealing with a couple of $1,000s.
I've been hearing a few realtors in some of my Facebook groups and stuff saying they're getting audited, like, and it feels like they're going after them. Like, in your experience, do you not think this is true?
The only time it normally happens is when you get stupid with the expenses. Like you make $50,000 and you have $45,000 of expenses. Revenue Canada's going to say, hello. Now again, it comes back to how much do you do, because you could have a prior year where you made $200,000 and you have $50,000 of expenses. But then you come to the following year and you could have a terrible year, but you still have that same $45,000 in expenses. As long as you can back that up, as long as you're realistic for what you've got going on, put it all through and away you go. And Revenue Canada won't give any problems. Normally, when you get audited, it's because it's a major swing, or you've come along and changed your car, or changed a significant one that they know that gets abused on a very regular basis. Which when it's the car is the main one, because most people, again, do you guys keep a car log for all the mileage on your cars? Didn't ask you.
I know you do, but you're the only person I know who
Yeah.
does. You do too? So what do you, like, how
Because
do you do it?
it's so easy now, it's a habit.
Yeah.
And I'm so deathly afraid,
Yeah.
because I've been audited twice
Yeah.
twice for HST and once for specific expenses when I was paying my father.
Yep.
Right.
And even though I'm organized, just
You just carry it, or do you put it
I
on
put
an
it,
app?
I have it in the car every time I get into the car. I do business or personal, and you kind of stretch the business, but it's there.
Okay.
Okay. And there's apps that you can get for your phone.
Yeah.
Yes,
I
there's an app,
tried one. It's,
Oh, I know. I haven't found one that works yet either. And they do crash on you. But normally it's the first thing the auditor asks for
Yeah.
is the car log. Now, I've never had an auditor look at a car log for longer than 30 seconds.
They just
They
want
just
to see
want
it's
to see
there.
that you're doing it.
Yes.
And mine, I'd get those little books. Is that what do you do, Scott?
When I leave my car, after a work thing, I just take a picture of my, mileage for that trip kind of thing. And then it's on my phone, and then it reminds me when I'm looking at my pictures, oh yeah. And then I just have a spreadsheet, so then I just drop it in the spreadsheet on the gate.
Yeah.
And go like Joe Open House or whatever.
Oh, that's smart.
Okay. Or just get one of the monthly calendars that you can print off out of Outlook and just keep it on your car. Because again, one of the things I do with all of my clients, I tell them, those big brown envelopes that you guys have or send paperwork out, get one of those and keep it in your car. So guess what? All your gas receipts go into it, all of your donut receipts, all your coffee receipts, all of your lunch receipts, everything goes into that envelope. So at the end of the month, you take that envelope out, get your Visa statement, match up your statements, and you got all your mileage. Okay, because you have that same monthly Outlook page in there, and just write down onto it. So if you were 67 kilometers in that day, then that's really all you need to know. Or you can go start and finish. It's up to you.
I bought a little, it's like a little accordion one.
Yep.
That has a couple slots, so I've got, you know, like car,
Yep.
meals, and then whatever.
Yeah, it
So
works.
then at least it saves a little extra.
Whatever you're after, it.
Sorting.
Half the battle that I found with most independent contractors and self-employed people is just trying to tame the paperwork. Okay, you guys got your Visa bills, but no one has all the backup that goes along with it. And especially for you guys, you need the backup.
You need the backup.
Because the HST does not apply if you don't have the bill. Because the HST number is on the bill. And you have to have that in order for it to be a deductible expense for Revenue Canada. Visa bill doesn't count. And if you go into a restaurant, you need both the bill and the credit card side. If you pay it on your credit card, because there's normally a tip or whatever else on it also, you need both sides. So it just really comes down to just keeping track of your paperwork is what it comes down to. And that's what I have found the simplest aspect onto it is, like I said, that envelope, you know, in beside your seat, all your receipts and everything else go in, so they're not blowing all over the car, and you haven't lost one, or it ends up down at your feet in the winter time, and it all becomes a papery mush as everything gets all wet. So that's where we kind of go with that one. Now, kind of 4 and 5 kind of come in together is when to sell your house, or move, live, depending upon your life. And this got into quite a conversation when I was here last time, is a lot of people, especially seniors at this particular point in time, have got parents, in this case, you have a very significant problem in getting the money out at a reasonable tax rate to pass it on to your children or pass it on to somebody else. Because most of our parents at this point in time have done very, very well over the course of their life in the stock market or wherever else. So they have a significant amount of money in their RSPs. Well, how do you get it out without getting killed onto it? Because right now, when you turn 71, and I'm much closer to 71 than I was a while ago now, but you have to start taking out your RIFs or your lifts. So the first year is 5.5%. So if you have $1 million in RRSPs or investments, that's $55,000. You add that to your other RRSPs or other investments, your Canada Pension Plan, your Old Age Security, all of a sudden magically you're up at $80,000. So as you can see from the rate here, you're in roughly at a 30% tax bracket, okay, for what you're being billed at. So now it becomes, you know, do we take more, do we take less? Because again, money transferring from husband to wife is tax-free, or from wife to husband is tax-free. But money transferring from the remaining spouse to the rest of the family is all taxed at once. So the house, primary residence, is tax-free. So now, how do we deal then with a rental property, with a secondary cottage or a secondary house, or other investment properties for what you have going on? And this is one of the key things is, we had a very large conversation, is do we incorporate or do we not?
Thank you, I'm sorry.
Because again, a lot of that comes back to your own personal situation.
I'm sorry.
No
I'm really
worries.
sorry. I hate this.
Pass that back. So the incorporation really comes down to, right back to your question originally, if you have a great year, an incorporation makes a lot of sense. If you have a bad year, incorporation doesn't make as much sense. Because a corporation's income is taxed at 15%. So if you make $100,000 in the corporation, you're going to pay 15%, or $15,000 to the government, which is going to leave you $85,000 left over. Now, as a self-employed person, or an owner of that company, you can dividend yourself almost $50,000 a year and pay no more income tax. And that's one of the key reasons why seniors love dividends, because they pay no more income tax on it. Now, it only works up to about $46,000. Okay? After that, the tax rate moves on, so it's only that first 46. So if you happen to have Canada Pension Plan, if you happen to have any other income sources, that number gets whittled down accordingly by whatever else monies you have coming in. But having said that, so if you take all your money that you're having in a real estate agent and put it into a corporation and start buying your rental houses. So what happens when you turn 65, now you can pull $50,000 a year out of your rental company for the however many years that you have it, and that basically becomes your retirement at that point in time. Now when your kids become of age, which is normally 18 years old, you add the kids onto the company, so when your time on earth is coming to an end, they become the owner of the company. So none of the houses have to go through capital gains, none of them have to go through probate, so it just continues on its merry way. So, which is a key component, because again, you know, if you bought houses years ago, what are they worth now? One of my clients happens to have 9 rental houses. His wife was a real estate agent. She has since passed, but he bought one down on Seton Street, 1972. $32,000. He just sold it for $1.8 million. So he has a capital gain of $1,750,000 on it. So he's paying tax on $950,000 or $850,000. So he's going to get dinged for probably about a $425,000 tax bill.
But coming out of the corporation, how much would it be if you liquidate one of the properties?
It's 15%.
Still,
Okay, again, depending on how far you get past and how much you've got going on. Because as the owner of the corporation, you are allowed to roll that income property or that cottage or whatever else into the corporation tax-free. No problem, no harm, no foul. There's no land transfer tax or anything else onto it because you own both sides of it. So what happens is at some point, just go,
So isn't there a deemed disposition?
Nope.
Like
you own both of
That's
them.
exactly what I asked last time, yeah.
Yep, because you own the corporation and you own the house. So underneath the Canada Revenue, under the Tax Act, you're allowed to roll that into the corporation. Okay, and there's no deed disposition or anything else.
Did we talk, I can't remember if it was here, about there being land transfer tax on the mortgage part?
Yes, well, we did get into that part, yes. So normally there's a land transfer tax if there is a mortgage on the property. So if the property was $1 million and you have a mortgage of $300,000, the land transfer tax applies to the $300,000 value.
that's when you're taking it from non-corporation into corporation.
Correct. Okay, because you're moving. If it's fully paid off, no land transfer tax.
Oh, weird.
Yeah, one of those little wrinkles. So,
Strange.
yeah, I don't make the rules.
Nope. You just enforce them and try to work around
Try to
them.
avoid them.
That's interesting.
So the land transfer tax is if you own a property and there's a mortgage and you're just changing title to it, which you would be doing because you're putting it under the corporation.
Correct, yep.
Okay, so then you're basically, if you've already paid land transfer when you bought it,
Right.
so now you're gonna pay it again just to put it into that
Just
corporation.
whatever value of the mortgage
Of the
is.
mortgage.
Just on the mortgage.
Yeah, not the whole property value again.
If you
Like
were,
if you bought $1 million house right now,
Yeah,
you have a $30,000 tax bill in Toronto.
right.
So if you have a $300,000 mortgage onto it, when you transfer, you're gonna have a $9,000 land transfer tax bill.
if you transfer into a child or spouse name, are you
Same
paying
deal.
just on a mortgage?
Yep, just on the mortgage.
Just on the mortgage. But you can't transfer it in, if you have a mortgage, you can't transfer it into their name unless they can qualify for the mortgage, right?
Right. Now, you can
So
add
you
their
want
name
transfer
to it.
prior to title.
Versus transferring it solely to their name. You can add it to it, there's no land transfer tax onto it.
Keep yourself on it and just add them.
Yeah, because again, that's called right of survivorship at the end of the day, because if you transfer it to Alex, for argument's sake, okay, when your time on earth is done, she automatically becomes the owner of the house.
Right.
So there's no probate, there's nothing else onto it. Which brings you back to my next thing for you guys, is you need to keep really good records, okay, on what it was purchased, what you spent onto it, to get to that point in time. Because somewhere down the road after you're dead and gone, someone's got to dispose of that property. And if you don't have the records to prove your backstory onto it, the government will say, well, you know, we're going to take a capital gain on all of it. So, and that's the other aspect that a lot of people also skip over. Primary residence is tax-free. Okay? However, if it stays within the family, after 3 years, okay, you need to get a valuation done on the house, okay, for the estate. Because that becomes your basis when it's sold in the future, where the capital gains are. If there's no valuation, Revenue Canada will go back to 0. And you pay capital gains on the whole house. So if mom and dad had a house worth $1 million, it's tax-free underneath their hands. You guys kept it, didn't get a valuation or nothing to prove of what they paid for it. When it comes time to sell, Revenue Canada will just do capital gains on all of it. And it's up to you to try to prove them different. So it becomes very, very key paying attention to the paperwork for what you've got. But the incorporation kind of comes into play as like, if you're going to buy a house and only flip it for argument's sake, the corporation is not the route to go. Okay? Because by the time you get the money in the corporation, get the money back out of the corporation, you're probably better off just do it through your personal income tax anyways. Okay, it's just a cheaper overall alternative because you're only going to own the property for 6 months or 8 months. If you're going to buy something and hold it for a long period of time, corporation is the best way to go about to do it because it doesn't affect your income that goes like this or goes like this on an annual basis.
What's a kind of ballpark long time? Like
Over 5
years?
years.
Over 5 years?
Yep.
Okay.
Just, again, the main fact is, you know, I'll go with $100,000 at this point in time. If you're making $10,000 in your corporation off of a rental house, on your personal tax return, you're going to pay, you know, roughly 25, 27%. In the corporation, they're going to pay 15. You know, so on an annual basis, you know, it adds up over the course of a number of years. Plus what the corporation does at that point in time, it allows you to get more expenses off into the corporation. It can pay for your car, it can pay for cell phones, it can pay for your house repairs and all kinds of other things that you have going on because you need to make that happen each and every year. Because again, every house needs to be maintained, windows,
And would that
driveways.
have to be then part of the corporation? Your bills for your cell phones and
That's what
your
I
cars
was
and
Well,
stuff?
they can be in your personal name, you own
It
the
can be,
corporation.
right,
Yeah, I
okay.
mean, because 9 times out of 10, none of the corporation, whether you're Rogers, Bell, or whatever else, normally will give you credit in the corporation name because you don't have a history. Most of them, all you have to sign a personal guarantee for anyways, so just put it through.
I guess my question is sort of, it's Heidi, right?
Heidi.
Yeah, Mia, I haven't
Oh,
met.
hi.
So, like, if you have a $200,000 year, say, in your real estate, like with commissions.
Yep.
But you're having a $25,000 year in your corporation.
Right.
And you're using all of the, like, your house stuff, you know, for like your office, your car stuff for your corporation, you can't be using it then for your personal,
It
right?
all comes back to where, how do you want to go about and play with it? Because again, you know, corporation is one side, personal is another. If it makes more benefit for you to claim it personally, then let's claim it personally.
Yeah,
If it makes more benefit to claim it
Okay.
business, then
Right.
claim it business.
yeah.
And this is where you have to kind of know your situation. What are you trying to do? How are you trying to get out of it? And then take it accordingly. And again, it could be anything else, and you could be charging, you know, monies off to the corporation, again, because you know it's gonna come back to you at a later point in time. So because all that money that you invest in the corporation, I'll say you take the $500,000 out of your house and put it in the corporation. So that money will come back to you at some point in time tax-free. Okay, because that's already tax-paid money that you've invested in a Canadian-controlled private corporation. So whether that money comes back to you and how you take that out is entirely up to you. If you want to leave it there for your kids that's somewhere down the road, that's perfectly fine too. So again, it comes back to what everyone's own personal situation is and what's the best way to go about it. Whether you want to own duplexes, whether you want to own sixplex, whether you want to own an apartment building, or you just want cottages. Again, everyone has a particular niche or what they're comfortable with or what they're not comfortable with. But again, it all comes back to what expenses are we going to be able to write off against it, and what are we going to benefit for you guys? And the incorporation, you know, part that goes through it, yes, there is a little bit more paperwork onto it. It's not looked at quite as hard by Revenue Canada as a personal income tax return is, because it's considered a business, and you have certain expenses in that business. Okay, so as you go through that, but what it does, it allows you guys then, you know, I'm looking at buying a house in Victoria. Yeah, so you're there for 2 weeks. Put it through the business. Okay? You got great vacation out of it, but the house didn't pan out.
So how do you take your income, your commission's income, and put it into the corporation and
Can't
pay
at this
yourself?
point in time,
Yeah.
okay? Because the Ontario government has not let you guys become incorporated agents at this point in
But
time,
there's talk of it right now.
There
right?
is.
Yeah.
okay?
And if that changes, then we can work under the corporation
Yes.
and pay ourselves a salary.
Yes, okay? But what's gonna happen to you guys, and probably the same thing that happened to all of us, and all the professional corps out there, the government came along and said, oh yeah, we want you to do it a professional corp, you're gonna be treated the exact same way, and they took all that away 2 years ago. So now, all the money that's in our corporations, anything that goes on is taxed at 49%.
What do you mean, anything that goes on? Like-
So, again, I'll give you a perfect example, one of my doctors, okay, he was making almost $500,000 a year, okay? So he kept the money in the company, because it was only taxed at 15%.
Mhm.
Okay, so we got out there, invest the money, invest the money, invest the money. A lot of years go by, he's got $5 or $6 million under investment, making 10% a year. Okay, so he's done very, very well. So before, still taxed at 15%, no problem. They changed the rules, all that money now is considered, oh God, how's it go? I forgot it, I hate when that happens. Anyways,
50 plus. right?
no, no, I forget what it's called,
I'm talking about the head being 50 plus.
oh, no. Oh, God. I hate it when that happens. Anyways, when you're not doing anything to earn the money, okay? So anything that, so if you're working,
Passive.
passive, thank you,
Yeah.
passive income and non-passive income. I couldn't come up. So it was considered passive income. Passive income is taxed at 51%.
In a corporation,
Yes,
Whoa.
okay?
In a,
not in a
In a
residential.
professional corporation, stuff like that.
So
Right.
doctors.
Doctors,
yeah.
lawyers, dentists, accountants, stuff like that.
So if I understand you correctly, if you're a doctor and your main income is being a doctor, but you're making income under your umbrella as a landlord.
Yep.
And the money that comes in, is that considered passive?
If it's all still underneath the same corporation. So what you do is you start a second corporation, have the doctor's professional corp loan the money to the second corporation, now it becomes non-passive income. Okay, oh yeah, it's,
They don't make it easy.
they don't, okay, because once the money's invested in a business per se, it now is considered non-passive income, because you actually physically have to work to make that income.
Does it matter if the same people are the shareholders for the same corp, like,
Not
none
at
of
this
that
point in time.
matters?
No,
Oh, one of my clients is a doctor, and we had just rented a condo for him, and we were talking about property management, and he said, I can't because it can't be passive income for
Yeah.
me.
Yeah.
Because it's going through the corporation. Now I got it.
Yeah.
Interesting.
yeah, and it really, it's screwed up a lot of people, big time.
And did they change that without a lot of advance warning, like it was rather?
None.
Yeah,
Yeah, there are a lot of people that are very, very upset with that. So again, so if you happen to have a finance company, say you loan money, any money the finance company makes is taxed at 51%, because it's all considered, passive income. It's just brutal at this point in time. But again, so the whole object behind it is you have to take a look at your own situation, what is best for you, and what assets do we have, husbands, wives, kids, grandchildren, whatever else, as far as for then trying to get that money out of the corporation at some point in time going down the road. And I use this example at this point in time, and Irene happens to be a perfect one on this because she has 2 children that will be going to university shortly. So you're not done working yet. But in a corporation that rents the houses, over a 4-year university education for a child, you can get almost $300,000 out of a corporation tax-free in dividends paid to that child.
even if they don't work for the corporation?
It's a dividend, they're not working for the corporation. They own part of it, they own shares.
So in order to give them a dividend, they have to be a shareholder when you
Correct.
set up the corporation?
No, when they turn 18, when they become of age.
Oh, so really, I could go into one of my corporations and just put my daughter down as a shareholder now that she's 18,
Yes, you can,
even though she doesn't do anything?
correct.
Sweet.
That's what a lot of my doctors.
I'm sorry, probably I missed that, and I'm a recent newcomer. What kind of corporation that's supposed to be?
Just a Canadian-controlled private corporation, the CCPC,
Okay.
like a regular basic corporation that you're
Okay.
doing
Yeah,
whatever
yeah,
you're doing
yeah,
at.
I understand.
Because what happens is you have your basically, your first $50,000 is tax-free, then you have all their education monies that kind of come up against it also. So basically you get almost $75,000 a year, you know, through a
So
child.
that 50,000 is for each shareholder.
Yes. And that's traditionally why when you set up a corporation, you set up Class A, Class B, Class C, Class D shares. You set up a number of classes. Main reason being is each class has to be paid the same dividend amount. So if you have all 3 kids in and they're all Class A and you give one 50, you gotta give the other 250. Whereas if it's a Class A and child 2 is Class B and you only issue a Class A dividend, so you only pay it to the one child.
So all you need to do is just remember the
Therapy's a different
concept of
expense.
this. And then when the time comes, you call Alan and say, okay, what was that thing about the shares and the kids? Remember,
Yeah.
just the kids and shares thing?
So it does make a big difference, like over the course of time.
So that's $50,000 per year, per child?
Where did the $300,000 sum come in? Because there was something else.
It's over 4 years because they still have their basic, they still have all their school expenses,
Right.
which adds up on top of it. So traditionally, by the time you add in your basic exemption and the school stuff, you're up about $75,000 per child.
Gonna have to have a wee chit chat.
Okay. Now, money can go into your bank account. It doesn't need to go into theirs. All you're doing is papering it.
And let's say a child of 18, what are you taxing them at? Because if you're giving them a dividend, then you have to look at what is the tax.
See, she wasn't here.
You missed the beginning.
You missed that.
I'm sorry, I
First
left an
fifty.
offer out.
First $50,000 is tax-free.
Per annum,
Yes,
per child?
For dividends.
for dividends, per anybody, not per child, per anybody. That's why seniors love
Paid
dividends.
dividends,
But that's
right?
assuming 0 other dollars.
Correct. But most university kids that are going to school make next to nothing.
Like
Okay.
a summer job
Or,
something.
well, again,
Earn
correct.
10,000, so it's
Yes.
really up to
It's
40.
probably $65,000 that I can probably get out to them at that point in time. So, yes, because traditionally the first $50,000 in dividends are $47,000, whatever else is tax-free. Because you've already paid the tax onto it in the corporation.
And you don't have to show the flow of funds to them?
Nope. All you gotta do is issue the paper. So, that way you can go into your bank account or wherever else you need going on. So away you
The
go.
realtor in me loves this, and the good citizen is like, boy, that's a lot of money not,
But-
like.
You also have to remember though, you know, when you guys are making your money in your real estate agent, okay, and you've got it invested off on the other side, what it does allow is you can pay your income tax, pay your income tax, pay your income tax to your corporation. Your kids come of age, now it all comes out tax-free. If you happen to have 2 kids, in Irene's case for argument's sake, she can get almost $600,000 out of the corporation. You only paid 15% tax.
But the corporations have to be making money.
That's always a good start, yes.
In order to pay a dividend.
Now, but having said that, you hit the nail on the other side. It doesn't need to make income to issue the dividend. If you know the money is coming, you can issue the dividend early. So now the money is just owed to you at some point in time down the road because you've already paid your taxes on it.
So you're just putting your money, once it's taxed, into that corporation.
Or you know that you're going to sell a house 3 years down the road and you're going to make $500,000 on that house.
Right.
So what you can do is you can pay the dividends out early. So what happens when it comes along to that particular point in time, all you're doing is booking it on your set of books. So if I issue Mia a dividend in 2015 for $50,000, 16 for $50,000, 17 for $50,000, 18 for $50,000, she's paid or she's filed the income tax return on each one of those for each years. Now, I haven't paid her anything, but I've issued it. Okay, now comes 2019, I sell the house, I make my $500,000 onto it, I pay my 15%. Okay, so I'm out of pocket 75, so I got $425,000 left in the company. $200,000 is already gone. So write the check for $200K, away it goes.
I think my head's spinning.
And how long
Yeah,
do you do
yeah,
that?
you might need
Sorry.
to rewind on
Yeah.
that. one more time.
Or I think we just need to have him hired so he,
The whole object behind it is it has to make money at some point in time.
There's a reasonable
Because-
expectation, right?
Because you're not gonna issue a dividend and pay tax onto it to a certain degree if you're not gonna make money in your corporation.
When does it, so if you declare the dividend,
Yep,
so when does the 15% get paid? The year you declare it,
no,
or the year it's paid?
the 15% is on the income in the
Oh,
corporation.
right, okay.
Okay,
The
so
15,
the 15% could be 4 years down the road. Okay, or 5 years down the road, or whatever else. The dividend when issued is taxed in that year when you issue the dividend. So you had a terrible year for argument's sake, and you made no money on real estate, like that's never happened, right? I've been through 3 crashes, trust me, I know what happens. But what you can do is out of your corporation, you can issue yourself a $50,000 dividend.
Don't pay tax on it personally.
You put it through here, you're not paying any tax on it personally. Now when the corporation makes some money, then the corporation just pays you the $50,000 at some point now in the future.
So even if the corporation has 0 assets,
Correct.
and then how long can you do that?
As long as you want, because again, at some point in time, you're paying or sucking up the money. If you're never gonna get the money out of the corporation, why would you do it?
So what's the downside of doing it then?
Well, you're gonna owe money.
Well, you're not necessarily gonna owe money, but if the company owes you, also you do it for 5 years,
Okay,
the company owes you $250,000,
right.
how are you ever gonna get that money?
If it doesn't make money.
If it doesn't make money.
If the corporation never makes money,
there's nothing to be paid.
how are you
But
ever
I'm not
gonna?
gonna sue my corporation, like, I mean,
No,
so
I
what's the
understand.
downside on that, that the okay, so
You-
on
you-
paper, the corporation owes me money, but
Right.
then what happens?
But you're gonna pay your personal taxes onto it, it's gonna go through your personal tax return, sorry. Okay, and you're not gonna get any benefit of that $250,000.
So you're not getting the $50,000, you're only declaring it. You're not paying tax on the $50,000. So what's the
No,
purpose?
no, you're paying tax on it here, on your personal side,
15%.
but you're, no,
Oh, that's before.
No.
Putting it in.
but you're not paying on it in the corporation because you haven't made the money yet.
Oh, I see what you're saying, okay.
Yeah.
It's declared income,
Yes.
right, got
Okay.
it, okay.
I'm sorry, I missed it, but that's okay. I missed the first part of your thing, so I'll probably have to.
Whoever you issue the, so if my corporation issues a dividend to me, right, so I'm kind of trying to save the money on the corporation, that's still $50,000 income I personally have to declare and pay
Right.
tax, personal tax on it.
Yeah, but it's,
But for the
Only
most
good
part,
for
you're not.
seniors or kids,
Yeah,
or.
no, but for the most part, you're paying minuscule, like a couple percentage points, if that, on your tax return.
so you don't pay a lot of tax on your dividends?
Correct, on the first
$50,000
$50,000.
per annum.
Correct.
Oh,
What would
But-
you, when do people incorporate? What do you want to have before you incorporate?
It really comes down to your own personal situation, and I know I keep harping on this one aspect onto it, but it really comes down to, what are you gonna buy, how are you gonna buy it, okay, and what is your plans for that asset or what you are planning on buying. If, like I said, if you're just planning on buying something and flipping it, a corporation is not the route to go, okay? Unless you wanna make it a viable business, you're gonna do 2 or 3 of them a year. Okay, then a corporation is the best way to go about it. But if you're only gonna do one every 2 years or one every 3 years, just keep it in your personal name and move forward with it. Okay, and you won't have that problem. But you have to be careful from Revenue Canada's side on buying and flipping now, because they changed the rules. So if you do more than one every 3 years, it's considered a business.
Right.
Okay? So again, if you're looking at doing, a buy and flip every year or 2 of them per year, put it through the corporation. Now, the corporation becomes a little bit more of a hiccup now because depending on whether you get a mortgage on it or not, but most times you can still get a personal mortgage and it's in the corporation because you're signing for it personally. So, again, so back to your original situation, and this is where, this one. I ended up with a winery in BC by accident. It's just one of those situations.
By accident.
I did. But I did exactly what I went through for 5 years beforehand. So we got it for $600,000, sold it for 1.9. Okay, I'm paying tax on over $200,000 when it's all said and done.
Wow.
Okay? So again, how do you flow things around? And in case
But you
anyone,
have to keep that money then in the corporation, right?
well, it's owed to somebody.
Yeah,
Okay, so what that somebody is, then you just pay the money out accordingly. Okay, because all the expenses have already come through. Now, in case you're curious, I got 12 businesses of my own. So I deal with this on a day in and day out basis. Okay, so this is nothing to me. This is
and
old hat
each
now.
business is incorporated?
Yes.
See, the question that I'm really confused about, or what I'm really confused about, Terra Equity, the previous brokerage that I was with, he would suggest that anybody making over a $200,000 income as a realtor incorporate themselves.
200?
Is that gross or
Then
net?
you can incorporate yourself as a business.
Yeah, but what are you gonna do with
How
it?
do you do that?
You're still paying the money personally, because you can't incorporate. You cannot have your commissions paid to the corporation. It's illegal. You can't do it.
If you're operating as a team or as a,
I still haven't had anybody tell me how that yet. I have my lawyer look at it, I still haven't got down that road yet.
So people that work as a team and have incorporated,
Yeah.
the commissions are still being paid to an individual, not to the corporation.
Right, because the individual's the one holding the real estate license.
So then, what's the benefit of incorporating?
Yeah.
Because
No.
it's more expensive.
It's when you get off on the side and you start buying other investment properties and you start doing everything else. All of your monies, I'm not talking your real estate monies to go through a corporation. I'm talking taking your tax paid money from your real estate and investing it off into a single house, a duplex, triplex, a sixplex, cottages, whatever else that you have going on. So that way it becomes, money that's going to work for you in coordination with perhaps monies from your line of credit on your house or monies that mom and dad have loaned you or whatever else that you have going on. So again, it comes back to, just the proper mix and the proper place to put it.
And can I say, it sounds like from like what we're hearing with the shift from 15% to 49%, that maybe being able to incorporate as realtors in the long run isn't
Well,
necessarily going to be a good thing anyway.
the
We're
biggest
gonna
problem-
tax it
you're
as a
still gonna go after
business.
you for your tax on your income.
But now it would be 49% because everything would be
Yeah.
considered a business, even our commissions,
Well,
right?
if you take a
That's
look at
what-
the top page, you can see, if you make $200,000, your effective tax rate is 46%. So on $200,000, you're gonna lose 20% on the first 46, 30% on the next 46, 37, 41 on the 46. So you're gonna ultimately probably have a $70,000 tax bill on a $200,000 income. Which sucks tremendously. But, again, it's called a success problem. And it's a problem that everyone wishes they have. I get all my clients that bitch about the amount of tax they have to pay, and I'm like, well, suck it up, you made that money, you gotta pay the bill. Most people, I don't wanna pay the bill. Wow.
You're gonna have
Stop
to
making the money.
eventually.
Exactly.
I know.
But this comes in very clear, based upon parents, based upon kids, is how do you get that wealth transference now? Because they're saying over the next 10 years, there'll be more than $1 trillion that will transfer from our parents downwards. And that $1 trillion is gonna go into real estate, the $1 trillion is gonna go into investments, and go into cars, and go into everything else. Because a lot of the people now, if they don't own a house, they're not gonna go buy a house. Because they still can't afford one. Even mom and dad give them $600,000 or give them $1 million. They don't wanna carry a $500,000 or $600,000 or even more mortgage to buy a house. So that money is just gonna get ultimately spent at some point in time. If they already have a house, it's gonna go into home renovations. But there's a significant amount of money that's gonna transfer over the next 10 years.
And
Well,
what do you think will happen with that?
and this is where, for everyone who has parents that are still alive at this point in time, you really need to take a look at what is their income mix, how much money do they have coming out, and this is where it becomes very, very key. Because if mom and dad make $60,000 a year each, okay, they're taxed at 29%. All right? Whereas, so the tax rate goes to $93,000. So they've got $33,000 more in that tax bracket that they can pull out that they're still at 29%. Now you ask me why do I bring that up? Because what happens then is if you're able to pull out an extra $33,000 at 30% per year, you're paying $9,000. So I'll go with 10, 9 times 10 is $90,000. If you wait until mom and dad pass away, and that $33,000, which is $330,000 on their tax return in the year of death, is going to be taxed at 50%. So just with a little bit of advanced planning, you've saved yourself over $60,000 over the course of those 10 years. Okay. Now again, some people okay, not my problem. You know, they can deal with it when I'm gone. But my whole object is why give it to the government when you don't have to. And so the whole object is to take a look at mom and dad's taxes. And a lot of parents have done it themselves or have kept a lot of that information to themselves over the course of the years. And it's a very, very tough road to get down to get mom and dad to share. Okay? But again, you know, $60,000 over the course of 10 years is a significant amount of money. Same as investment properties, same as whatever else that you have, is there may be some very significant tax advantage to perhaps adding a child's name to it or doing something else to avoid it going through probate, to avoid a mess or whatever else that you have going on. Because here's one that you guys will appreciate knowing. Who has RRSPs in this room? Who's a beneficiary on your RRSPs?
Spouse.
Daughter.
Kids.
Okay.
Kids,
Right, so we'll go with the daughter first. Do you have just one?
Yeah.
Okay, she's screwed. The reason why, how many kids?
One,
One son?
2,
Okay, so are they both beneficiaries or just one?
both.
Okay. Reason why I bring this up is beneficiaries of an RRSP get paid out as entirety. So if there's $250,000 in the RRSP, your daughter's going to get a check for $250,000. Your estate gets the tax bill.
What's the tax rate?
Because we did something with the banks and got around that, but it wasn't RSP, it was a RIF, because my father was
Well,
doing
the
RIF
estate
things.
pays the tax on a
The
RIF.
estate still pays the tax.
What's the tax
Somehow
rate
we
though?
Depends how much money you make.
Is it on you personally,
But if,
or is it on the
It's on the
estate?
On the estate.
but how?
So whatever
You know
their
what it
tax
was, I
bracket
cashed
is.
it out. I mean,
How much money does the estate make?
Whatever happens to be there when they.
How much
Oh,
money does the
Back-
estate pay you?
Back to what Scott originally said before, deemed disposition happens on the date of death.
So you have to be on top, yeah, because we did this with my dad. We started moving stuff over because he was the last surviving. And when we sort of had an idea, we started taking more out of the RIF and
Yeah.
paid taxes.
Yeah.
That's what we did. Because I didn't get hit with a tax bill at all.
Yeah.
Knock on wood.
And how did you not do that?
Because she started taking it out years in advance to
Yeah.
minimize the tax hit onto it.
Yeah, we figured, not that we had any idea, but, I mean, obviously, we made sure he was taken care of, but everything had somebody else on it, so there was always somebody else on the bank account, somebody else, so nothing got frozen in probate.
Yeah.
And because there's 2 people,
Okay, the problem that you're up against right now, the banks are getting real sticky now. I'm dealing with one right now. I did their wills 2 years ago, and the bank wants them to put the primary residence through probate. Okay?
are they alive?
No, the mom's died.
Okay, and the bank wants them to put it through
Yeah, the
probate?
3 kids get ownership of the house as per the will, and the bank has told them it has to go through probate.
Were any of them on title before she
No.
died? But that's part of the issue,
But
we
is-
made sure we were on title.
No, okay, understood, but
If
you,
it's paid, then it
but
should
you
be
still have a
covered.
different issue, depending upon how it's treated from the tax perspective. As long as you are dealing with it from a tax perspective, fine, and making sure dad is, or mom, whichever one happens to be left standing, is paying the taxes on that deemed position, then you're fine. It's where things drop off the table and people forget about that.
Oh,
Okay, because what happens is if, you know, the 2 children here, all of a sudden, mom dies, they get the house. They don't think about it, they keep the house, they're living in it or whatever else. And all of a sudden, 3 years pass, now all of a sudden they become owners of the house, but the primary residence was passed off because they didn't do it on the estate return or the last returns for the, you know, for mom. So you gotta pay attention to what you're doing when it comes down to all these particular assets at the end.
Does it make sense, because it's interesting, we always say if there's, and I could be wrong, but if there's an elder parent and there's a child or whatever, we always say try and get on title, but sometimes the lawyer will say, well, wait till you sell the house to go
Yep.
on title, assuming the person's alive, but
Well, what you also have to remember, see, if you already have a house,
it doesn't become your principal residence and you have to pay the taxes on the capital gains.
probate on
Increase,
that.
not the probate,
No,
not the
not
probate,
probate.
the increase from the time you go on title to the time you sell
Right.
it.
so, but again, depending on what you've got going on, if you just keep the house and you're the only daughter, you just keep the house, then
Yeah, usually it's just
Yeah.
sell it. or-
most people sell it, but in some
Yeah.
cases you keep it, then you have a capital gains issue at some point in time.
Yeah.
It's right
At
down
some
the road.
point in time. How long does it take, how long do you have from the time that you pay your probate tax to actually keeping the property or eventually selling it?
They normally give you 3 years.
3 years.
Normally is kind of the rule of thumb onto it. Unless it happens to be a difficult estate where, you know, things are taking longer to, you know, because you have long-term investments that you're waiting to clear out and stuff like that. The house is still being used to support another child or something. Again, each situation is different.
Mhm.
But for the most part, 3 years is kind of the rule of thumb that they kind of run with. Yeah. So again, it just comes back to everybody's situation, but again, you know, as you go through it, it's just, you know, timing with this, whether it be real estate investment, estate, taxes, even your own personal returns. It's just a matter, like, speak with a good accountant. Unfortunately, not all of us are good. There's a lot of people out there that don't know nothing.
Can I go back to a question, you were talking about, we sidetracked it, or I sidetracked it, RSP.
Yep.
So you were saying your child, if you put your child on the RSP, so let's say you have 250,000, the child gets the 250,000, and then the estate
Gets the bill.
Gets the bill.
Yep. Because the RRSP slip is issued to the estate.
So they give the 250,000 net the tax,
No,
right?
there's not net the tax, it's 250,
Oh, and then they say after, you figure it out,
and the estate pays the tax.
okay.
Yep.
And how do they come up with the tax? Like, what's the percentage on the estate that they?
It's just a regular tax return. So if you get past $200,000, you're 47%. It just, that's why I broke it down to give you how the breaks go on both federal and the provincial side. And it's just, in the estate, it's the exact same way. So on deemed disposition, you know, when your RSPs are deemed to have been sold, all your investments are deemed to have been sold, it all comes into income in 1 year, all at once. So if you happen to have $800,000 that comes into your income all at once, then your $400,000 is going to the government.
Oh, that's
There's no way you can get around that.
Nope,
It's called estate planning.
exactly, and it's just taking care of your parents. You know, taking care of the situations for what you've got going on. Much like what you have done, much what I advised, you know, from this side, if you can take out that $33,000 extra every year for 10 years, you get to the end, very little is gonna come into income at that point in time. Because you've already paid your taxes on it accordingly.
Plan government came out.
Joys of life.
But on that RSP, like, when you put that in, you never paid any tax on it, so it's just, you've been deferring it to.
Yeah, but
Yeah,
you've got the
tax
tax
money.
break onto it.
You got a tax
Oh,
break
it
on,
means
you
you
paid
Plus it's
tax.
tax paid money, so what you're paying it on is on the growth in the RRSPs over the course of the year.
Right.
But what I'm saying is, on the beneficiary onto it gets the money, the estate gets the bill.
Right.
So you gotta have money in your estate.
Well, what ends up happening traditionally,
Beneficiary.
you normally have got a house, and this is where things get real cranky. And I've had this happen, whereas the estate is split between two people. Okay, normally sisters, brothers, daughter, brother, whatever else you want to refer to it as. Well, the RRSP
Goes to
is
someone.
not considered part of the estate, because it's already been paid out. So what ends up happening is the primary house comes in, it's worth whatever amount of money. So the estate pays the tax bill, but whatever money is left is supposed to be split both ways. You got one child that's normally pissed off because the other one's got $250,000 more.
Yeah.
Okay?
You think you're, oh, I'll give the house to this one and the ours keys to the
And
other, and you don't really understand.
Nothing splits up a family quicker than,
Put it into a corporation,
On
so
equity.
it's all under one, and then they have 50/50 shares, right?
Sometimes even when it is equitable, they still fight.
yes,
Is, I mean, is this super sneaky? Could you go, could I go and title my parents' house
yes.
and then transfer my portion to my corporation?
Not while they're alive, you couldn't.
Okay.
Good try.
But if,
I get what you
if
think.
Or could I
Janice
take-
goes on title with her parents' house and they pass away,
Yeah.
will their share be part of their estate, or does it just naturally all go to her
Goes to her.
If
Isn't it
she's
depends-
the only child at that point in time.
and on
then-
title?
And she becomes owner of that house. She then, once parents have passed, then she can transfer the house into the corporation.
Wouldn't there have to be joint tenancy or tenancy in
Yeah, I'm
common?
not
There
even
has
going
to
down
be
that
that?
Joint title, you do it prior to passing.
Yeah, no, I don't.
I'm not, and I'm not even talking about corporations at this point. If Janice goes on title with her parents today, and 5 years from now, they pass away, does the house naturally just go to Janice?
Yes.
Yes.
Assuming
And then she
it's-
can do whatever she wants with corporations?
With no probate
Yes
tax.
and no, because then you're dealing with capital gains and other issues that are gonna come into play.
How?
Well,
She already has a principal residence.
she already has principal residence,
Unless she lives there.
okay?
Well, I know, then my principal residence becomes
That
my
house.
income.
Yeah.
No, but if they pass, then I now have, well, even if they
You have
don't,
two.
I have 2 houses.
Right.
Yeah,
So
but you
that's
have a
income
certain
property
amount of
that
time
Time
to
to
disperse
twice.
that asset.
Again, you have a certain time frame,
Yes.
correct?
Yeah.
Normally it's 3 years,
Right.
but if she's gonna keep it, then you're gonna deal with a capital gains issue at some point.
But
right
if
down
you
the road.
sell it, then you're not taxed on it,
No,
and if
because
it's a
it's
joint,
primary
there's no
residence,
probate.
and money's all gonna go to,
To her.
and you're good to go.
So in other words, when you go on title, it's good to get an appraisal or have something so that you can prove a value
Yes.
at the time you go
Yeah.
on title.
And I tell all my clients that, I said, said when, a parent passes or whatever else, get a valuation of the house if you're gonna keep it, and if you're gonna sell it, that's easy. Because obviously the real estate paperwork, says what it was sold for. But if you're gonna keep it, get an ironclad valuation onto it, so at least you have your basis for what goes on, because that is tax-free underneath the primary residence. So even if you happen to keep the house yourself, okay, it is a secondary residence, no question, but if it's worth $1.2 million and you have a valuation for that $1.2 million, you're dealing with the house being sold on mom and dad's tax return, no problem. And it's tax-free on their tax return, no issues. But you've got the basis now, so 10 years down the road, you sell it for $1.5 million, you're only paying capital gains on $300,000.
That's in the corporation.
No,
it's a person.
no.
Oh, personal.
Yep.
So what happens if you have two primary, so you have a primary residence, then you inherit a property.
Yep.
Something happens with your matrimonial primary residence, that no longer is your matrimonial primary residence. And the second property then becomes your primary residence.
Right,
And then 5-10 years down the road, you sell that property.
okay? So there's a page on the tax return, you gotta put in the number of years you owned it, the
Yeah.
number of years it was your primary residence.
Yeah.
Okay, what it was worth then, what it was worth now, and they do, that does the math for you.
You just have to prove it.
But it's only the number of years that you're in there as a primary residence that are exempt. The number of years that you did not have as a primary residence are still coming to capital gains. Trust me, you had all kinds of people that wanted to do that when the real estate market was going absolutely stupid with all their cottages and everything else. And the government's like, no.
No, and that's why they wanna know everybody's,
Do you
when
want
you
one of
sell
Alan's
your
cards?
house now, everybody has to
Do you
declare
want
the
one of
year.
Alan's cards?
Oh, you
got it?
Yeah.
Yeah.
Thank you so much.
No worries, cheers.
See you soon. Bye.
The main reason why they wanted to do that was two. One is for to get the people that are buying and flipping houses,
Mhm.
okay, because a lot of people are just doing it and making, a lot of money tax-free, saying that primary residence. And the second aspect onto it, I either want their taxes, but it's just mainly to keep track of what's going on now, because the house values have gotten so high. Okay, that they want to know that, it is a primary residence and you're not doing this as a business.
Mhm.
The unfortunate aspect of it. So, again, it's just, whether it's me, whether it's somebody else, it's just pay attention to what you've got going on, and find out whether your accountant knows what they're doing or not, and, research. Because your situation is different. But again, I write everything off I possibly can across everything. If your accountant tells you, no, you can't do that, then time to go start looking.
My own.
So
Oh, Okay, so.
Well, if I could just answer that question for a second. You should have at least it done professionally, probably once every 3 or every 4 years,
And I follow that.
just to have an idea on whether or not what you're doing is in the ballpark. And if you're writing off everything you should be writing off.
Plus the rules change so much.
They change
It's
every
not
year.
your
Every year,
profession.
right?
Yeah,
It's brutal.
yeah.
So anyway, sorry.
So are you mostly like doing taxes for realtors or do you?
I have 9 of them that I do taxes for. I have, it crosses the gamut.
So you have good idea. I find my accountant, he teaches like ethics and stuff at school and that's all great, but he's
Ethics,
so
there's
like,
ethics involved?
oh yeah, no, he's like, he teaches like.
Does he
loving
do other
accountants.
realtors?
No, and everything, he's
So,
like,
yeah, you
no,
want-
and I'm like, no, I'm pretty sure, dude, like I
What's on
can
the
do
real
this.
estate?
My whole thing
And-
behind it is, I write off everything right down to your foundation garments. Everything. Manicures, pedicures, hair,
How do you
makeup.
write those
Yeah, he
off?
won't let me. do
Under
it.
business expenses?
Absolutely.
Perfect.
Business supplies.
Like the lawnmower and the snow blower, if my office is at home, I have to
Yep.
gain access.
Absolutely.
Right?
Like he won't let
And
me
credit
do
card
home
interest
use
if
of
you
office, cause he's like, are you
use
allowed
your
to
credit
use a
card to
desk
buy
at KW? I was like,
Credit card
sure, but
interest.
it's a bullpen, like I can't,
Thank you.
I need to do stuff from home.
Yeah, so
He's not letting you write
No.
part of the house?
No,
Oh my
I've-
God.
I read it all off.
I'm done.
Well, just remember, if you write off part of your house, when you go to sell it, you have to claim that back, right?
No.
If you write off, let's say you have a 9-room house and you write off one room consistently year after year and then you sell that house, isn't there something to do if you have to, like you're selling something that you've been getting a tax break on, isn't there something you have to
for the
declare?
most part, Revenue Canada doesn't care.
Okay.
Because usually
No.
it's so small.
There is provisions underneath the Canada Revenue Act that if you rent out part of your
Don't
house,
start it.
or if you use part of your house for business, that part is not subject to primary residence, okay? However, it's not enforced.
Okay.
Because how many millions of people across this country would fall underneath that bracket because they have a home office, or they have an apartment, they have this, they have that?
Would you believe I had Revenue Canada at my door?
For that reason?
No.
For
I s-
what?
I used to have a nanny. I
Yeah.
stopped having a nanny and then we hired a caregiver for my mother-in-law and somehow the accountant put it through on my tax, did something, put an error. Next thing you know, they kept calling me for the tax,
Yep,
various
T4,
things.
yep.
And I said, I don't have any, and realizing it was the accountant's error. They showed up at my door. And I'm like, are you kidding me? I'm thinking, really?
So what did they say when they came to your door?
I called the accountant.
Yeah.
I said, here's my
Ask
tax
them for
return.
information?
I said, here's my tax return, here's his, because he has to sign off. I said, go talk to him. And I paid him. I mean, he's done our taxes for years. But I thought, are you kidding? You're at my door?
Yeah. I deal with Revenue Canada every day.
I had never heard of that
Yep.
before.
Oh, I've had them show up for surprise audits and stuff like that too.
Yeah, but I'm just a person living in a house. Like,
Yeah.
oh, yeah.
The best one that you guys will appreciate, and you guys will get a chuckle out of this, so I had one of my clients, he was a real estate agent, funnily enough. He filed in 1995 and never filed again.
Oh, my gosh.
So Revenue Canada
I think I know his name.
did 96 and 97. So they sent him a letter in 2009 requesting him to get his tax returns up to date. Well, by the time he got to me, it was 2010. So 99 had already fallen off the table at that point in time, because you can only go back 10 years. You can't go back further than 10. So anyway, so I finally get it all, I'm in the process of getting done. The collection office out of Hamilton shows up at his house. It says, dear sir, if you don't file your tax returns, we're gonna put you in jail. So he says, no problem, let me lock the house, I'll get in the car. And the poor collection guy was like, what do I do now? And because Jim, that's his first name, he thought, well, if they're gonna give me a bed and 3 meals a day, it's better than what I got, so I might as well go with him. But what I did learn out of that particular situation, which I was not aware of, once they self-assess it, the Canada Pension Plan, the unemployment insurance, or whatever else they've self-assessed, stands. It doesn't change. So they based it on him making $30,000 a year for those 10 years. So this Canada Pension Plan was $3,000 a year.
Jeez.
Okay, when I got it all done, he made roughly about $7,000 a year. okay?
I can't even imagine starting 1995 and doing taxes forward.
Oh, well, I already had 4 of them that fall off the table. I did 2000 up to 2009 at that point in time. But I do a lot of them for 10 years at a time.
Oh,
Good lord.
Oh,
Oh,
I
yeah.
get
do you
stressed when I'm
even-
3 months behind, when I don't do my GST in 3 months.
Your accountant comes like, 2014, this restaurant, was it business or was?
Oh,
And the last thing I'll tell you, and then I'll get out of your hair, is if your accountant is not standing in front of you, as far as Revenue Canada goes, get a new accountant.
yeah, well.
Because I tell all of my clients that there's 3 things you tell Revenue Canada when they call.
Name,
Hello,
number.
how are you? What's your name? What's your phone number? My accountant will call you back. And that's all you say,
Yeah.
nothing more. Because they will take it out of context and they will use it against you.
Yeah, that's the best phone call to get. Here's the.
How far back can you go on your taxes?
If they prove you've done something deceitful, as far back as they want to go.
I
No,
thought it was
I'm
only
saying
7
if there's,
years.
if there's some things that are lacking, say for instance, on a tax return from 2012.
They can still open it up.
No, but can you go back to
Yes, you
say,
can,
you know
yeah.
what, these are my expenses from that year that were not included in my
As long
tax
as you
return?
can back them up, go to
Okay.
town. Okay, but 10 years is the normal rule on
And
it.
how do you file that with them?
it's
10 years.
10 years, not 7?
I thought it was 7.
Oh, it's always 10. It's always been 10.
Oh,
Now, you're only required to keep the paperwork for 6, but they can go back 10 years if they want to audit you.
That's a hell of a way to prove something when you've gotten rid of the paperwork.
But are they